Futures and options, that is F&O, looks complicated, but in 2 minutes you'll understand futures, options, and how they relate to stock prices in the simplest way. A futures contract is an agreement to buy or sell a stock later at a price that is decided today. Key points: no shares change hands today, prices are locked today, settlements happens later, that is on expiry day, and profit and loss depend on how the stock actually moves. Simple example: stock price today is 1000 rupees. You buy the futures at 1020 rupees. If the stock goes to 1080 rupees, you profit. If it goes to 960, you actually lose. So futures contract means high risk because you must honor the contract. There is no escape. Similarly, an option is like a ticket. You get the right to buy or sell a stock at a fixed price, but you don't have to if you don't want to. There are two types of options contract. Call option means right to buy, and put option means right to sell. You pay a premium for this right, like booking an amount. Simple example: stock price is 1000 rupees, and if you buy a call option at strike price of 1050 for a premium of rupees 20, if the price goes above 1050, you can exercise or sell the option for profit. But if not, you only lose the 20 rupees premium. So options is a right, not an obligation. Futures is actually an obligation. Now, how do futures relate to a stock price? Futures generally trade slightly above the stock price, called premium, because they include interest cost, market expectations, and demand supply of traders. If futures trade higher, it normally means that market expects the stock to go up. If futures trade lower, it normally means that there is a bearish sentiment. Similarly, how do options relate to a stock price? Call options rise when stock goes up. Put options rise when stock goes down. Actionable rule of thumb: if stock goes up, calls become profitable. If stock goes down, puts become profitable. Your profit and options depend on four things: strike price, stock movement, premium paid, and the time left for expiry. Let's do a quick comparison. Futures are high risk, high reward, mandatory contract, move almost one to one with stock price. But options have limited risk, are flexible, there is no obligation, and prices depend on stock plus volatility plus time. Final takeaway: futures means commitment, options means choice. Both move with stock prices, but risk is very different. Check our recent video on Keynes technology and follow for more simplified market explainers.